So when they're looking to buy a home, they may be putting down a bigger down payment than just the standard, 20%, so they can avoid PMI. So
Hmm.
if they actually were to put down a bigger down payment, let's say we use 40% just as a running number in this case, does that play an impact in the interest rate in any way? Could it work
Yeah,
in
it
their
does.
favor?
Yeah, it plays a huge impact on there because it's all about LTV, which is loan to value
Hmm.
for the property. Now, of course, at 20% down or higher, you eliminate the PMI, the property mortgage insurance. So you, but that's separate from homeowners insurance. You always have to have homeowners insurance. But the PMI is what the bank or the government will enforce to have on the loan anytime the LTV or loan to value is over 80%. Um, View or putting down more than 20%, of course, your interest rate is going to be significantly lower than if you were to put a lower down payment. So, like for instance, like I have this one client that I'm working with. Originally, he had in the file that he was going to put the 20% down, and with 20% down, he got like a 6.75. Well, when he decided to, okay, well, hey, I have this asset that I'm going to sell, and I'm going to utilize these proceeds to make a large down payment. He put down 40%. His interest rate went from 6.75 to 6.05, which saved him, over the three quarters of a point, pretty much.
Okay.
Yeah. So that's the benefit of putting more money down. And as far as payment wise, it adjusted his payments by like $400, but not only because of the interest rate, but also because he was putting more money down.
Yeah, so you have more equity starting out.
Yeah, exactly.
Okay. And going the other direction, and this is I wouldn't mind hearing your personal opinion on this, but so
Hmm.
many people they're so scared of a deal that will result in putting less than 20% down because of the PMI. But a lot of people don't realize that when you do get over the 20% threshold, however long it takes, the PMI is going to go away.
Yeah.
So, like,
Well, only on
uh,
conventional. It does not go away on FHA.
say what?
Only on conventional loans, the PMI would go away, but not on FHA.
Gotcha. I'm glad you made that distinguishment.
Mhm.
Okay.
Yeah. So for FHA, the PMI stays on there for the life of the loan. So it stays on there for the full 30 years if you don't refinance into a conventional.
Hmm.
On a conventional loan, you can call the bank and ask them to drop it at 80%, but it will automatically fall off at 78% LTV.
Is your fear of personal finance holding you back from going after what you want? What if I told you there was a way to get rid of your insecurities? Every person has their own way of making money, budgeting style, and a way of spending money. The key to financial success is the ability to use the right styles for you that ensure success. So rather than making you focus on avoiding your emotions, this book focuses on empowering them and using them to achieve what you want. Learn how to build and increase the income streams you desire. Understand how to budget your money in a way that you are always moving forward financially. Know how to remove the stress from spending money by knowing what works best for your personality. Learn methods to effectively evaluate a financial opportunity within minutes to see if it's right for you. The Anatomy of Financial Success, the key to building financial confidence and destroying insecurities about money. Buy now. Available in ebook, audiobook, and paperback.
Okay. So, do you think that, let's say, the only way like a person is gonna can move forward is to put down under 20%? Would you just recommend that they just hold off on buying a home, or do you think that they should go ahead and move forward?
I think that they should go ahead and move forward. The reason being is so I always tell people it's like you're never going to get away from paying mortgage. You're either going to pay someone else's or you're going to pay your own. Like so, like even if you're in an apartment, the person that owns the apartment 9 times out of 10 they have a mortgage, on that entire apartment complex, and so you're renting an apartment where you're contributing to that mortgage cost every month. I'm all in favor of paying your own mortgage, just because, like, let's say in a year, 2 years, 3 years, 5 years, when you get ready to move, you're going to be able to recuperate some of the money that you paid, in every month, for that particular property. So, for instance, if you can qualify for a home at 3% down or 3.5% down, it's much better to go ahead and purchase the home or the condo rather than renting. Pretty much. Just because you're going to be able to get that appreciation. Now, where it comes in a huge benefit, let's say for instance, like right now in this market is, we would consider it to be a buyer's market, even though when you look at the reports, it's going to say that it's balanced. We would consider it to be a buyer's market just because the homes are typically going under the listing price. So if but the interest rates are considered to be high right now at this point. So if you could purchase a home right now would be the time to do it, because when interest rates are high, like I said, you get a deal on the property, even if it's 3% down. Well, let's say the interest rates are pretty much expected to continue to drop down, but it's going to be a slow drop during 2025, and we're expecting to have a property value increase once we get closer to 2026. So if you put 3% down, and then we see numbers like COVID again in 2026, well, that property has appreciated so much. You can call next year and ask for a rate and time refinance, or for the bank to send an appraiser out to get your property reappraised, and you may already be at that 20% mark to drop that PMI. So you don't have to wait that 7 to 13 years in order for that PMI to fall off. You can actually trigger it right away.
Okay, cool. And I think this is underrated, but let's say that, well, what you said is more likely to happen than not, but let's just, in some other alternate universe, it's not going to happen. We mustn't forget that you can pay down the loan to the extent that gets you above, the 20%, and then it will fall off that way too. It requires some financial planning. You get the income up and get it above that threshold, it can fall off that way too.
Yeah, that's definitely. So what I recommend to my clients is to, however you can. So once you make the mortgage payment for that month, make a separate additional payment of at least $200. If you make a separate additional payment, it's going to cut your mortgage time frame from 30 years to 25 to 23 years. And that's just by making an extra $200 a month payment. If you can make more, and you're directing that extra payment strictly towards the principal rather than your future.
I was going to say, you want to make sure you specify that, because now some companies, they will do it by default, but you got some companies, if you don't tell them make additional payments and direct it towards the principal, they'll direct it towards the interest.
Yeah, they will. So, well, now I think most banks have moved to being able to control your mortgage payments by app. And so, you can distinctively select, what you want that extra payment to go towards. Now, if you make it all in one payment, like let's say your mortgage payment is $1,500 a month, and you say, okay, well, I'm going to pay $1,700 this month.
Oh,
I don't
God.
understand that, because now that extra $200 just went towards the next month, rather than actually going towards the principal. This is why I encourage people to make separate payments, so you can directly, say that, hey, this extra payment I'm making is going to go towards the principal.
Yeah, and just so people can understand the totality of what he's saying, when you start a loan, you're paying mostly interest until you reach the halfway point, and it starts to bounce out to where you're paying mostly principal. But essentially, they want to get their money first.
Yeah.
That's why if you go ahead and pay the note, and then you make an additional payment and target it towards the principal, that works differently from making a bigger payment on this note, because it's just going to get rolled into the next month's payment. And if you just realize what I said, by default, most of that's going to be going towards the interest.
Yeah, that's exactly correct.